I'm the professor. I take complicated stuff and make it simple. Let's get into it and see how it works. Today we're talking about credit scores. That little 3-digit number can affect whether you get approved for an apartment, what you pay for a car loan, what your mortgage rate looks like, and sometimes even what you pay for insurance. But here's the good news. A credit score is not magic. It is mostly a report card on a few simple habits. Once you understand those habits, the whole thing gets a lot less mysterious. A credit score is a prediction. It is trying to answer one basic question. How likely is this person to pay money back on time? The score is based on information in your credit report. Credit cards, loans, payment history, balances, accounts you've opened, and public records if they apply. Different scoring models exist, but the basic idea is the same. Lenders want to know if you have a history of borrowing responsibly. The biggest factor is usually payment history. In plain English, do you pay your bills on time? One late payment can hurt, especially if it goes 30 days or more past due. A long pattern of on-time payments helps. This is why the most boring advice is also the most important advice. Pay at least the minimum payment by the due date every time. If you are forgetful, set up reminders or auto-pay for the minimum. The second big factor is credit utilization. That's just a fancy way of saying how much of your available credit you are using. If you have a credit card with a $10,000 limit and your balance is $9,000, that looks risky. Even if you make the payment on time, the score may see you as stretched. A simple rule of thumb is to keep balances low compared with the limit. Many people aim to stay under 30%, and lower can be better. So if your card limit is $1,000, try not to let the reported balance sit near the top of that limit. Credit scores also look at how long you've had credit. Older accounts can help because they show a longer track record. This is why closing an old credit card is not always the smart move. If it has no annual fee and you can manage it responsibly, keeping it open may help your credit age and available credit. Scores can also consider the mix of accounts. For example, credit cards, car loans, student loans, and mortgages are different types of credit. You do not need every type, and you should never borrow money just to create a mix. But a responsible track record across different accounts can help. Another factor is new credit. When you apply for credit, the lender may run a hard inquiry. One inquiry is usually not a disaster, but a lot of new applications in a short period can look like financial stress. There is an important exception. If you're shopping for a mortgage, auto loan, or student loan, scoring models often treat multiple inquiries in a short shopping window as one event. The point is to let you compare offers without being punished over and over. Still, don't apply for store cards, personal loans, and random credit offers right before a major loan application. And timing really does matter. Let's clear up a few common mistakes. First, carrying a balance does not help your score. You do not need to pay interest to build credit. You can use a card, pay it off, and still build history. Second, checking your own credit does not hurt your score. That's called a soft inquiry. Third, income is not directly part of your credit score. You can have a high income and a weak score, or a modest income and a strong score. The score is about credit behavior, not how rich you are. Fourth, a debit card does not usually build credit because it is your own money, not borrowed money. So how do you improve your score? Start with the basics, pay on time, keep credit card balances low, avoid unnecessary new applications. Don't close old accounts without thinking it through. And check your credit reports for errors. In the United States, you can check your credit reports from the major bureaus through annualcreditreport.com. If you find an error, dispute it with the credit bureau and the company reporting the information. If your credit is thin, meaning you don't have much history, a secured credit card, or being added as an authorized user on a responsible person's account can sometimes help. But only if the account is handled well. Bad habits attached to your name can hurt you too. Here's why this matters. Credit scores are not just approval or denial, they can affect price. A stronger score can mean better loan terms, lower interest rates, lower monthly payments, or more options. A weaker score can make borrowing more expensive, even when you still get approved. That is why improving credit is not just about bragging rights. It can put real money back in your pocket. The simple version is this: pay on time, keep balances low, be careful with new applications, and build a long, steady track record. Credit scores can feel intimidating, but they are not a mystery. I'm the professor, now you know. Thanks for watching. Please subscribe, and I'll see you in the next video.